Hey guys, Dave Keller here with Market Misbehavior. I love to ask people what their one chart would be, and that is if you had just one chart to help you get a read on the overall market environment, besides just a regular chart of the S&P 500, what would it be and why? Today, my one chart is sort of an echo of the video we did a couple weeks ago. We looked at the bearish divergence in semiconductors. Today, we're going to look at a similar bearish divergence in financial stocks and talk about why there's been a major sell signal for financials. So a couple weeks ago, I did a video on semiconductor stocks. We talked about how the price had gone higher, but the momentum was actually waning, and it's called a bearish momentum divergence, where the price goes higher, but less and less momentum on each increasing or each subsequent price rise. The interesting thing is when you compare the chart of semiconductors to what we're seeing with financials now, there's a lot of similarities with semiconductors about a month ago and what we're seeing with stocks like JP Morgan and other big financial names now. We're going to dig into all of those stories, compare the two charts, focus on some of the patterns that we're seeing and why this suggests I think the market overall needs to take a little bit more of a breather before resuming its uptrend. If this sort of thinking about investor behavior, decision-making, charting, and data visualization is of interest to you, I hope you will hit like below the video. Consider subscribing to my channel. I'd love for you to continue to see some of the great content I'm putting out. And put a comment below. Tell me what you think about financials. Do you think the pattern we're seeing in financials suggests short-term weakness, long-term strength, or are you seeing something different? Let me know below. Let's get to the charts. Okay, so a couple weeks ago, I actually did a video on the Semiconductor ETF, the SMH, and this is the chart we looked at, but now it's updated through today here in late March. The pattern we saw is indicated by the purple lines. You saw the price going higher in January and then February of 2021. You see the momentum indicator, the RSI, going lower. So higher price, lower momentum. It's called a bearish momentum divergence, and it indicates some internal weakness, some signal that all is not well. And what it really means, to be honest with you, is the price is going higher, but there's less upside momentum on the up days. So basically, if the stock moves with a normal pace, a normal trajectory, the second move higher is met with less buying power, is how I would tend to think of it. And so usually that is an indication of market tops. Actually, on this chart, you can see another really good example of where this played out pretty well. It's the February 2020 high. Look at the price going higher, December 2019, January 2020, February 2020. Look at how each time the market moves higher, you see the momentum actually moving lower. So it indicates weakening momentum. What's interesting is right now on the chart of the S&P 500, you're seeing a very similar pattern with the price going higher and higher. Every time the index has gone higher in the last couple of months, the momentum reading has been lower. So it indicates some lessening of demand, less buying power, indicates that there's less fuel behind every one of these upward movements, and it tends to be characteristic of a topping pattern, late stage bull market behavior. So this is what a chart of the SMH looked like. What's happened since then is we've now broken down through the swing low. That's the low from late January, broke down through that. And even though we've bounced higher back up to the 50-day moving average, I still see this bearish momentum divergence is indicating further price weakness. So I think we'll see further weakness in terms of price and or time before all is said and done. Now, keep that in your mind. And we look at the next chart, which is a chart of the XLF. Looks kind of like the semiconductor chart did a month ago, where you see the price going higher. We see this momentum divergence, higher highs in price, lower peaks in the RSI. And again, that indicates some weakening. Now, what actually caused this rise, this 8 to 12 month rise in financials, it really didn't start with the fury until the fourth quarter. You saw the gap up in the XLF. This is when a lot of banks really started to jump higher and then move up. Well, it's all about the interest rates, right? It's all about all interest rates going higher, and this the yield curve steepening, 10-year yields going up from about 0.5% to about 1.7%. That increase in rates is a huge tailwind to banks and other financial stocks. So if you look at the chart of the XLF, and if you look at the 10-year yield, you're going to find that especially the relative strength of the financial sector overlays almost perfectly with the 10-year yield and the rise in rates. Higher rates tend to be good for banks, and overall, especially at the beginning of a bull market, tends to be pretty good for stocks in general. Here's what's happened though. This bearish divergence, similar to what we saw with the chart of semiconductors, the bearish divergence indicates that the upward trend is exhausted, or we're near an exhaustion point. Higher highs in price, lower peaks in the momentum, sort of bearish. What we have not seen and what we saw in the semiconductor chart was a breakdown below the swing lows, which I would argue on this chart, you really would want to see the XLF go below the 50-day moving average. That would take it below its late February low as well, which means the XLF would need to get below 32 to really confirm this bearish divergence, to really validate the topping pattern and the fact that not just we're seeing trend exhaustion, but we're seeing trend failure and we're seeing a rollover in price, right? So exhaustion signals are sort of a leading indicator. A bearish divergence sort of tells you we're seeing similar conditions to other tops, but a validation or a confirmation where the price actually breaks down, follows through to the downside. That's really what indicates, confirms what you saw with the divergence. That's not what we've seen yet. If you noticed on the chart of the 10-year yield, by the way, I jumped over there really quickly. If you notice the blue lines here, you can see on the chart of the 10-year, you guessed it, a bearish divergence in rates, which basically means rates have gone higher, but the momentum is actually going down. If you look at the chart of the TLT, which is the long bond ETF, it's sort of this flipped upside down, lower lows in price, higher lows in the RSI. It has a bullish RSI divergence, a bullish momentum divergence right now. What that suggests is that bonds have sold off a lot. So, again, rising rates basically means bond prices are going lower, bonds are selling off. So the fact that the TLD has gone down, become oversold, that means that bonds have sold off to a pretty extreme degree, indicates downward exhaustion, indicates a bit of a bounce higher, which would pull rates down a little bit, which would hurt the relative strength and the performance of financial stocks, which would fuel the breakdown of the 50-day moving average that we've talked about. So the scenario we're sort of lining up here is growth stocks like semiconductors topped out in February. They're now in a downtrend. Financial stocks are now beginning to show the signs of a downtrend because of the divergence, and that's because rates have come up so much. They need to have a bit of a pullback, or to put another way, bonds have sold off so much. They need to have a bit of a bounce higher to digest all of these losses that have come recently. Overall, what you need to also remember is the relationship between the short-term pattern and the long-term pattern. The general thing I'm seeing for 2021 is very similar to what we saw in 2010. And if you know your market history, 2009 was the bottom in the first quarter. You had a huge rally to make new highs at the end of 2009. 2010 was more of a choppy sideways year. You made new highs and you made new lows. It was more of a broadening pattern through much of the year. But the second, third, and fourth quarter really is where the trend continued upwards. And 2010 ended up being a positive year. I'm anticipating sort of a similar pattern to 2021. I'm seeing a lot of choppiness, a lot of volatility. I'm seeing plenty of topping patterns here in the first quarter, which makes me think the second quarter is going to be more of a choppy backing and filling digestion rotation type of event. I don't think we're going to see big gains. I don't know if we're going to see big losses, but I see more of a non-zero chance that we see some meaningfully lower prices. But overall, I think at the very least we'll have volatility in a range-bound market. In the end, I wouldn't be surprised if this resolves higher. And I think the long-term trend remains pretty strong for interest rates. I think we'll see rates that go higher than where they're at today by the end of the year. At some point, I also could see financial stocks and other sectors in particular doing well. So these bearish divergences don't mean it's the end of the world necessarily. And even though the January-February 2020 top had a similar divergence on most of these charts, it's not necessarily saying we're going to see something that severe. What it does indicate, though, is trend exhaustion. And what happens after this is all about how we hold key support levels. What happened to the February 2020 top with financials, we broke down through that low in a big way and continue to make lower highs and lower lows. So even though you didn't know that entire 4-week sell-off was going to happen, you saw us break support levels, you saw us break moving averages. And as we break some of those key lines in the sand, you want to overall be thinking more risk averse and focus on the potential for risk, downside risk on charts that you're looking at. At this point, it's still very early days. And on the chart of the XLF, first things first, do we confirm this bearish divergence with a breakdown around $32 on the XLF, which would be the 50-day moving average, and also the low from the end in February. So that's the one chart for today. So our one chart is particularly looking at the XLF, the bearish divergence that we're seeing in financial stocks, how that relates to the 10-year interest rate or 10-year yield, and how that looks a lot like semiconductors did a month ago before they really rolled over and started a new pattern of lower highs and lower lows. What does this mean overall? That's what we'll continue to work on together here on the Market Misbehavior channel and elsewhere. If this sort of thinking about technical analysis, decision-making, investor routines, investor behavior, and sentiment, and everything else, I hope you'll hit subscribe to my channel. I'd love to have you come along this journey as we review the charts together. From everyone here at Market Misbehavior, I'm Dave Keller. Be safe. Talk to you again soon.